Good morning, this is Mayor Valensky with Driving Markets. Okay, so I'm going to make some slight changes to the YouTube broadcast. What we're going to do is going to keep it between 3 and 4 minutes because viewers are saying that 6 to 7 minutes is simply too long. So I'm going to keep it 3 to 4 minutes. We're going to have a quick run through. So if you recall, on Friday, the markets absolutely were hammered and they collapsed on Friday, and I expected that to follow through on Monday. And on Monday morning the futures opened up slightly, then the markets came off during the day up until the last hour of trading, when Goldman Sachs came out and made a report, an economic report, that they don't believe that the US or the Western European is going to go into recession on the basis of several factors. Number one, there is full employment in the States, and when there's full employment, it's very unusual to go into recession on the back of full employment. In addition to that, they also stated that there's huge amounts of cash sitting in investors' bank accounts from the COVID-19 stimulus that's happened over the last couple of years. You have to remember there's around about $4 trillion has gone into the COVID stimulus in the US to give individual households tens of thousands of dollars to ride out the lockdown and ride out the corona pandemic. So what they're stating is that this money is still there. I actually don't believe it's there. What I do believe is that that money's been used by the consumer to go and buy goods and luxury goods, which is actually increased the demand for those goods where the supply is limited due to the lockdown and due to the fact that there's very few factories producing full capacity, which has caused a shortage in the world. But let's go back to that later on. So Goldman Sachs doesn't believe there's going to be a global recession, and that caused the markets to turn around on a sixpence, and where they were down 400, 500 points, they ended up closing up on the day on the back of that report. What else have we got? We've got the US 10-year treasury benchmark bond running at 2.99%, the highest in 4 years. It's only a tad away from the 3%, which is a major landmark. If it breaches 3%, then investors will be extremely concerned for the future of the financial strength of the stock market. Remember, the Nasdaq is hypersensitive to rate rises, and any particular interest rate rises, which there will be by Wednesday when the Fed meets, but any interest rate rises, the Nasdaq is going to come off as a result of that, because the Nasdaq is all based on a high growth stock and highly speculative stocks. Therefore, what you're going to have is investors leaving the Nasdaq, leaving the high growth, leaving the tech sector, and moving into more safe havens like bonds and like other assets and securities. Also, Apple is under investigation for manipulating its production, manipulating its supplies of Apple in Europe. So the Europeans are opening up a investigation on Apple as to restrictive practices, and Apple could be hit with a fine, and the shares were down yesterday on the back of that. However, most of the tech sector was up: Tesla, CRM, Google, Salesforce, etc., etc. Expect dollar strength going forward. You have the FOMC meeting today and tomorrow, and rates will go by at least 50 basis points, and by the end of the year likely to be 5% in my opinion. Cryptos are down simply because they're a high risk asset, and it looks like cryptos or Bitcoin's going to go all the way down to around about the 32,000 level, and then it will test that and we'll see where it goes from there. This is Mayor Valensky with Driving Markets. Have a good day.